and we will get going because it's 9:01, and you guys know I like to start on time so we can get out of here on time. So the first half of this class is going to be the SLS guys talking to you about financing and kind of the basics and also the nuance that would be helpful for you to know as an agent. And then the second part will be me going through like the contract forms that relate to financing. And just talking through how to like fill them out strategically. So I will let the guys take it away. What every agent should know about financing.
Good morning, y'all. So I'm going to start this off a little bit. We're going to break it up into three parts. I'm going to do the first portion, then Michael's going to jump in, and then as Zareen just mentioned, she's going to finish up. One of the things at a board meeting or a board that I'm on that we were chatting the other day, we always have an icebreaker question. And the question the other day was if you could instantly be an expert on something or could instantly have a special talent or skill set, what would that be? And as you can imagine, there were some interesting answers, some that I shall not even repeat. But one of them that came up on a regular basis was, having an expertise that supports you in what you do day to day. So, for instance, for guys like Michael, Ashton, and I, if we could be an instant expert in real estate, even though we don't talk about it, we defer those questions to you, to the professionals, because that's a big part of your real estate practice and what you do. But having a working knowledge, the better the working knowledge, the smoother the road is going to be for us. The same is the same for real estate agents, especially when I'm talking to newer real estate agents. The more they understand about the financing, the better they are. And a lot of this stems from communication during the transaction that, it's just like lawyers talking to each other using legalese. Real estate agents have their own set of acronyms, their own set of slang and code. The lending industry is the same. And a lot of times agents will get frustrated throughout the process because they're not properly communicated or there's questions that come up that they don't want to ask. So I always say that if I was a real estate agent, the superpower that I would want or the expertise is going to be on the lending side. And I think that starting there will allow people, I always look to see what can we do to increase the number of closed loans, by, 6 or 10 in a year. That's the difference between an okay year, an average year, or maybe in some cases a really good year. So as we see on this first slide, there's a lot of information out there and a lot of it's not good. And what I would suggest you do is if you have questions that come up, even if you've had the answers before, call Ashton, Michael, or myself. And a lot of this stuff where the rubber really hits the road is in smaller groups, which this is, and in one-on-ones. So what we want to talk about, and you hear about processes, you hear about practices and procedures, we want to kind of get to how these different types of loans and the fundamentals more so than anything works. Can you go to the next slide, please, Zareen? Okay, so one of the big things that comes up is what is the difference between an actual pre-approval and a pre-qualification? My 30-year anniversary in the mortgage space was on Valentine's Day. How fitting! It was an extra special day. My wife and I went to something that we didn't want to do. We didn't even, well, we actually did want to do it, but we didn't go out for dinner like so many people. But a pre-approval is an actual underwritten approval, with stipulations or conditions. A pre-qualification is something that we used to do on a cocktail napkin. We crunch a few numbers, we figure out the debt to income ratios, and get an idea of what somebody qualifies for. If you go back 10, 12 years, most of the pre-approval letters that were put together were based on this. Some of them might have had a credit pull. Ashton, Michael, and our approach and the lenders that you want to work with, especially if you have a complex borrower. You want to make sure that they have been pre-approved with a full underwrite. And as you're seeing in comparison to crunching some basic numbers on the napkin versus actually collecting all the information and having an underwriter look at it and get a conditional approval is a much, much bigger asset or a better way to go for your client. So for instance, when pre-approval is put together and the borrower starts shopping, then the communication begins with the agents in the offer process. So the difference between a pre-approval and a pre-qualification is when the listing agent receives the offer and they call the loan officer, which I would suggest the loan officer is proactive and calls them on the heels of the offer. But one of the first questions that a good listing agent is going to ask that loan officer is this a pre-qualification or a fully underwritten pre-approval? There's a huge difference. So when we're talking to agents, so an offer goes in, let's say one of you puts an offer in, we call the listing agent. Most of the time we get voicemail, but a lot of us will send out a text with our information so that they'll get an idea that they're going to receive that call from an unrecognized number. That person, that loan officer is going to say, we can't talk about non-public information, but I know that you just received an offer, from a Briggs Freeman real estate professional. Assets, income, everything has been underwritten. They are ready to go, short of getting an appraisal, title work, and homeowners insurance. Now, the other thing, and when the lender talks to the listing agent, sometimes, not always, sometimes they will actually show their cards, which they should not. So if I'm calling an agent on an offer that one of y'all put in, then I'm going to listen. And I'm hoping that they're going to say, well, we got a couple offers, but we're still looking. That tells me that they didn't get a full price offer or they got a lowball offer. And I can't unhear the information that they give me. And that's good ammo for you in how you're going to negotiate from that point forward. If I hear something or they show cards, then the first person I'm going to call is you and say, hey, this is what I found out. It sounds like there's a couple of additional offers. And that all comes in with having a good relationship with that lender and being able to feel that you can call them at any time. When you are working with your lender, what helps you as a real estate agent, whether you're on the listing side or on as a buyer's agent, the less that you have to chase people around to get information, the better. So if your lender is of the good sorts, they're going to communicate with both sides. They're going to do that in a proactive way that keeps you from having to chase things. Before you have a question, it should be answered by that mortgage professional. The better relationship that you have with your lender, and I would sometimes suggest, of course, we want you to chat with us about all the possibilities, and this will kind of be my end of selling us because I know this is actually a CE class. You actually have to have a couple different sources for mortgage lending. Maybe you have some portfolio type of things. I would tell you that most of your day-to-day lenders that are local can cover and do most of the transactions that you're looking to do, but every so often you have a one-off, so it's good to have multiple relationships. Can you go to the next slide, please? Okay, this is a very simple illustration of this process. So initially, that napkin pre-qualification that we spoke of, that's where things start. And a good lender, when they have that initial meeting or conversation, is going to ask probing questions to get an idea, one, what the person is looking to accomplish, but two, looking for immediate pitfalls. A lot of people think they have a pretty good idea of what their credit is. I'm sure you've got clients that say, say that they have an 850 credit score, but in 30 years, I've never seen an 850 credit score. So we have this 5 or 6 step process that needs to have communication through these various milestones. The pre-qualification, as I said, was the upfront, doing some basic numbers. But what I want to insert between pre-qualification and processing is the actual borrower or buyer application process. Now, of course, times have changed. We used to meet in person. We used to take what we referred to as a 1003, which is another code for residential mortgage loan application. We'd type that in, we'd give the people a list of things that they need to get together. Technology has made that a lot easier for us. At least that's what it's put in place for. So we can use an application that comes over the computer, or actually, even though I struggle more and more with technology every year, I every month or so get in and do my own applications so I can feel the pain of people doing that. So a handheld application on your phone is actually pretty easy to complete. Lenders have scanning capability so that they can upload all that information. So after they make the application and they upload the needed W-2s, pay stubs, if they're self-employed, they're going to need entity tax returns. It's all in the questions that are asked up front. It's all in the information. Once all of that is collected, or for the most part, it goes into underwriting. So processing is collecting the information that supports the application, and underwriting is the section. And I would argue that underwriters, for the most part, are of higher intelligence than most people. That being said, they're very analytical. So their job is to look very, very closely at the information to make sure that someone meets the guidelines. After underwriting, they're going to issue a conditional approval. At that point, your lending professional should have a pretty good idea of how that approval is going to come out, based on either information that was not provided up front, but could still get approved on. A prime example of that is if you have a client that's buying a new house, their other house is already under contract, and they're going to get the proceeds from the closing of that home a couple days before the new. Of course, we're going to have that settlement statement to have the underwriter review that they have ample assets from that transaction. That's something that you're not going to be able to have prior to the approval, because it's a timing thing. And then of course the closing is everybody's favorite part. When we go to the table, documents are signed, the loan's funded and recorded. Now, during this process and through these milestones, your mortgage professional should be communicating with you. In fact, I would argue that they should be communicating with you, as I mentioned earlier, before you have questions. Now, everybody has interesting clients. No two are the same. And I would argue right now that we're seeing things in the last 12 to 18 months that we haven't seen in years and years and years. And for instance, if somebody applies and a few days later, the real estate agent is anxious to know, hey, can I go out and start showing homes? And sometimes there's a glitch and it comes into that thing of non-public information. So one of the things that a lender should do, because for instance, if I had a referral from one of y'all and they had a bankruptcy, 2.5 years ago, and there's some residue that's still showing up from that, I can't tell you, Mr. or Mrs. Real Estate Agent, hey, this is going to take a little bit longer because they have a bankruptcy and we need to clean up a few things. What I typically do in that case is I ask how comfortable they are with the real estate agent and would they allow everybody to be on the same page. That is a key thing in communication with the lender and the buyers. Of course, we don't bring the listing agent into this because if there is an issue up front, it could cause a little bit of a panic. But the better we all communicate, and when the buyers are open with you about issues that are keeping them from the path to homeownership, are going to, cause the path to be a little bit rugged, the more everybody knows, the better. That, 7 days into it, the agent's not wondering, hey, why aren't these people approved? They told me they had 850 credit. Well, they might not have. So the communication is a big deal. Since we have a small group, is there any questions on this journey process? It hasn't really changed much in the last 30 years that I've been involved, just the technology. Can you go to the next slide, please? Okay. So there's four basic components of being approved, and the collateral is the third and really does not have much to do with the actual buyer. That's the appraisal of the property. But the three main components that we're looking at are always the same. It's going to be the income, the assets, and then the income is compared to the liabilities to get what we refer to as debt to income ratios, or DTI. Is everybody familiar with what debt to income ratios are? So Fannie Mae, Freddie Mac, FHA, VA, USDA, they will all let us spend a certain percentage of our monthly gross income, what we wish we could take home before Uncle Sam, on our house payment, and then the amount that we can spend, or the percentage that we can spend on our house payment and the rest of the monthly debts that we have. Now, a general rule of thumb, and it didn't used to be this way because everything capped out at about 41 or 42%. In most cases, we can now go to 50%. And I'll talk about that a little bit in a couple minutes. Income is very interesting, and the self-employed buyer is much, much more difficult than the W-2. So for instance, I still do a lot of work with Boeing employees. And if I see a Boeing loan, I know that they've been there for, X number of years. They're W-2, so their pay is simple. They typically have, 700 plus credit scores, and they're looking to put 20% down. That's easy. A self-employed borrower may have multiple entities. Now, here's one of the biggest things, the mistakes in calculating income that lenders will make. They will look at tax returns and they'll go immediately to the taxable income. They'll see that number and they'll work off of that number and say, hey, these people, they don't qualify. They don't make enough money in this scenario. But a good lender is going to look at that because there are certain things that can be added back into the income. Schedule E, of course, there are multiple expenses that people pay, on their property that can be added back in. Income tax returns, or 1040s or corporate tax returns, whatever it is, they do not show income or in a way of cash flow for qualification. They show tax event or tax liability. So it is up to that lender to go in and properly process that income. Liabilities are very, very simple. They come up on the credit report. It shows what the minimum monthly payment is. It shows what the current loan amount is, and it shows the history of that. As far as liabilities are concerned, that can get a little bit sketchy too, because what do a lot of people have? They have student loans. And student loans are one of the things that we see bounce people out of qualification or decrease dramatically their qualification. In some cases, they don't have to be counted. I guess what I'm saying as far as the process is, it needs to have a close look taken, and a lot of deals and a lot of people are told that they don't qualify when they probably actually do. Also on the liabilities, through the credit report that we get, that is going to tell us what the credit score is. And I'll talk a little bit more about that. That's one of my last slides before we transition to Michael. Now, the debt to income ratio comes from comparing the comparing the liabilities to the income. It's a simple matter of, okay, we have a $3,500 a month house payment. We have a $500 car payment. So it's basically $3,500 for the property, and it is $500 in other debts. That's divided by the income, and that gives us a percentage. So the front number, or the top number of the fraction, is the percentage that somebody is spending on their home. Now, if you go back to when I started in this business and there wasn't a lot of the technology, the general rule of thumb is somebody could spend 28 up to 28% of their gross monthly income on their housing payment, and a total of about 36% on all debts combined, which includes the home. Now that's changed dramatically because what we've done is everybody uses automated underwriting systems. And that's one of the first questions, going back to pre-qualification versus pre-approval. If I was a real estate agent and I was talking to that lender and it wasn't one of us, because we're going to keep you informed, first question I'd say after I said, is this a pre-approval or pre-qualification? Has automated underwriting been run? Has automated underwriting been run? Because automated underwriting is going to show compensating factors that allow these debt to income ratios to go up. So for instance, I always say cash is king. If somebody's got a good credit score and they have good assets, but they're pushing their debt to income ratio, the algorithms in that artificial intelligence are going to take those compensating factors into consideration, and then will allow that person to go a little bit higher on those debt to income ratios. If you were thinking about this and you were lending your own money and somebody had a 750 credit score, or excuse me, a 7 whatever credit score, they had a bunch of assets beyond what their down payment and settlement were going to be, but maybe their payment was pushing it a little bit higher. Those compensating factors can tell you the reason that person has these assets, has minimal debt, and has an overall good complexion is because they've minded their business and they've kept their finances on the forefront and they've taken care of them. They know what they can and cannot take on. So that pushed a little bit higher. So in the general rule of what they say, conventional loans, it used to be 28% over 36%. Now with an automated underwriting decision, it can go up to 50. Now, if you have a lender that's saying, yeah, our DTI is a little bit high, it looks like it's going to be about 52 or 53%, that's going to pose a little bit of a problem on a conventional, and that's Fannie Mae and Freddie Mac. Now, your FHA loans are going to go a little bit higher. The highest I think I've had is, I think, 59 or 60. Sometimes there's internal rules that lenders have that say, hey, this is the max that we're going to go up to. VA loans, which are a little bit further down on the list, I've actually had a 63% debt to income ratio approved. Now, from the surface, as a lending professional, one would never want to set anybody up for failure, but each case is a little bit different, and based on the compensating factors, if it goes through automated underwriting, it's something that if we can document, then we can close that loan. Now, the USDA loans, which you can keep it on here, but I'm going to finish up something on there. The USDA loans are actually written to FHA guidelines. However, the mortgage insurance is a little bit more tolerable, but it has to be in a targeted area. So one of the things that I always suggest, if somebody has a listing and they think it might be in a rural area, because USDA, just like the meat, it is a rural development loan. And if I was taking on a new listing, one of the first things I would do is I'd check out the USDA map, and you can reach out to any of us and we can get you the links to find out if a property is eligible. But if that property is eligible through the USDA, you just have another segment of buyers that are coming your way. The all-in-one, which we've talked about a lot lately, it pretty much has a hard stop on a 43% back-end debt-to-income ratio. On the folks that we've been qualifying for the all-in-one, that usually isn't an issue because these people have pretty good cash flow. On the credit scores. So this is a mystery, and I would argue, even though my wife Jennifer, who's also a licensed loan officer, has been in the business about a third of the time that I have, she's a little bit more of a credit expert, and she's in her office right now, and I'm afraid I'm going to say something and she's going to pop her head out and say I'm wrong. But this little graph below, let's go ahead and just divide this into thirds. Let's go ahead and say repayment history is 33%. Let's go ahead and say that new credit credit mix and age of credit or length of credit history is 33%. And then let's say total debt is 33%. But what I want to do is I want to change that total debt to revolving credit. If you pay your credit or your clients pay their bills as agreed, they're going to score great in the third that has to do with paying on time or repayment history. The thing that kills most of the scores for people that pay on time is their utilization of revolving credit. So the general rule is you're going to score well on that third of the credit if you have your revolving accounts, or if your clients have the revolving accounts below 1/3 of utilization. When those credit cards balances get up to more than 33%, and let's just keep the numbers simple. If a person has $1,000 limit credit card, and if they're at $330, I'm using simple numbers, $330 a month in balance or less, they're going to score well in this area. When they go up ahead of that 1/3 threshold, they really start hitting the points. I've seen many people, I'm sure Michael and Ashton have too, that once they might have a 740 credit score and they run 2 or 3 of these cards up, their score can drop 50 or 60 points. The other third is the overall mix of the credit, the type of credit and the length of time that it's been out there. Another thing that I see people make a huge mistake on is they go out and they close a bunch of accounts that they never use. That does 2 things negatively to them. It lowers their overall age of credit, and it raises their utilization. So if I've got 10 cards and I have $1,000 available on all of them, I have $10,000 available. And if I close 2 cards or 3 cards, let's say, I now have $3,000 less. So does that make sense that if you close available credit, that potentially is going to drop your credit score? Likewise, if somebody has a Home Depot card and they owe 500 on 1,000, if they raise that limit to 2,000, now they only owe 500 on a 2,000, and they're going to score those points. I'm getting into the weeds a little bit. What I'll finish up on as far as credit is there's a lot of consumer credit engines or services that are tied to Chase, Capital One. You all have heard of Credit Karma. And for the most part, these are not accurate at deriving scores. I have heard multiple different things, but it's come down to that all the 3 repositories, TransUnion, Equifax, and Experian, all have 52 algorithms to arrive at their scores. So three repositories times 52 is 156 algorithms. Credit Karma uses exactly 0 of those algorithms. So how do they arrive at those scores? Bottom line is the majority of the time, those services tied to cards or those consumer services, those scores are dramatically lower than they state they are. Okay, this next one is one of my favorite things, and I think this might be one of my last slides. It has to do with how rates are quoted. If you compare like to like, everybody gets their money from the same place. If you compare like to like, for the most part, everybody's fees are the same. Title, appraisal, it's almost like they got together in a back room and decided what they were going to charge. I'm not, accusing anybody of collusion, but it does level the playing field. Now, what's interesting is in this transition over the last year, as the rates had continued to rise and now settling down a little bit, how things were priced has changed dramatically. So a par interest rate, when you hear somebody say par, that means the interest rate that they are getting does not have any rebate or credit from the lender to them, and also does not have any discount points that the consumer pays to get a lower interest rate. Now, somebody can pay additional points or additional fees to buy down that interest rate temporarily or permanently. I don't typically suggest a permanent buy down in this market, because I believe that anybody who's purchased in the last 18 months, anybody who purchases now or in the next 12 months will likely be refinancing. So if somebody's permanently buying down their interest rate, they're leaving money on the table. Getting a lender credit is something that we use in some cases to assist a buyer that is otherwise qualified but may not quite have enough to close. So for instance, if today's par rate, meaning no charge of discount and no credit, was, let's just say 6.5%, if they decide to go with a little bit higher interest rate, which increases the yield for the servicer, meaning if I hold that person's loan, if I'm getting 6.25, 6.75 versus 6.5, I'm getting more income on the servicing of that loan. So I'm going to turn around and I'm actually going to provide, as the lender, a credit to the buyer to help them bridge the cost. So for instance, let's say they were $2,500 short in qualifying for the actual settlement date. What we could do is they could take on a slightly higher interest rate, and they're getting the benefit of that in the form of a credit back to them at closing, which cuts into their closing costs. Paying points is something that really was not a thing until probably 12 to 18 months ago. Was a thing a long time ago, but people very rarely paid additional fees to buy down their interest rate unless it was the seller providing it to them, because it really did not have a return on investment for them. Now, in some cases, with most lenders, on certain programs, there are no par rates, though, so there is going to be an origination fee. And with that, I'll turn it over to Michael, and he can talk about some of the fees and the likes. And I thank you all for your time. I have to drop off and get on another call, but any questions you have, you can call any of us, email any of us, text any of us at any time. Y'all have a good weekend.
Thanks, Buck.
Thanks,
Thank
Bud.
you.
Appreciate it. All right, team. When he showed the teeter-totter on that, just real quick, basically go down to the par rate, lender credit. No, go back to Ashton. So here you have par rate, lender credit, and discount point. So on that teeter-totter, he's talking about par rate. So we're not doing a lender credit, nor are we charging discount points. So that's where the par rate is. The middle column is the lender credit. For those who are maybe tight on cash, we can price the loan at a higher rate and help pay a portion of the cost. And then on the discount points, they're wanting to, they have additional cash, and they want to get a 7 versus a 7.5 or a 7.25. You see the cost there. So we're just letting you all know that we educate the customer. We don't tell them what to do. We just let them know what their options are. Next slide, please.
Yep.
So on this permanent buy down options, at one time, a lot of people were looking to really buy it down. So here's a quick example. 7.25, you notice no discount point. They're wanting to buy down 1 point, 7%, costing 4. 6.75, 1.5 points. And then on the third buy down, paying 2 points. We're kind of getting away from this is because our company in particular has what's called rate rebound. So what we're emphasizing to them is maybe pay a point, but don't pay any more. Here's the reason why. We'll let people refinance as many times as they want within 5 years. We pay all the lender fees. We pay a portion of the title fees. So it's just an FYI to y'all what we're talking about with them. I'll let them do whatever they want, but we're really trying to stay away from really buying down the rate. Next slide. As far as type of loans, mortgage loans, all seasoned veterans. Just as a reminder, we have conventional, FHA, VA, USDA, jumbo, and then I'll talk about the condo space. On the conventional conforming, we can do as little as 3% down. FICO scores typically have to be at least 620 or higher. flexibility wise with it's really what Buck talked about with the algorithms. They recognize risk. So conventional loans, they feel less risk because they have mortgage insurance. If the borrowers happen to default, the MI company will cover with the lender. Next slide. FHA is a lot of times or for customers either maybe don't have the high credit scores, they're low on cash, or they're the first time home buyer. So it allows more borrowers the opportunity to go in and create a dream, build their home. What I want to emphasize is on bullet 4, what they do, they add mortgage insurance into the loan that's financed, and then they pay monthly. So when somebody says, well, I've got 6.75%, okay, what type of loan is it? It's FHA. Well, when you add in the cost for the mortgage insurance, it ends up being close to 6 or 7.625. So sometimes we just kind of educate them. If we go conventional, we can get rid of the mortgage insurance eventually. Just to let y'all know, with FHA, until they refinance out of an FHA, they can't get rid of it. So if they were to happen to buy down the loan 50%, they can't drop the mortgage insurance. It doesn't matter. Next slide.
Real quick,
Yeah.
so you guys see right here where it says seller can chip in up to 6% towards closing costs, and on the previous slide, seller can chip in up to 3 to 9% towards closing costs. You know, in our changing marketplace now, where sellers may not be offering the full or a 3% buyer's agent commission, if you have 3% in your buyer's rep, and the seller has advertised that they're only offering 2.5% or 2%, your buyer can pay the you know, the delta out of their closing costs, which is what the buyer's rep agreement provides, and you can write that into 12A1B. So that's a nuance. We don't need to spend a ton of time on it, but I just wanted to point that out to you guys, that that's an option if the seller isn't covering buyer's agent commission and the buyer is going to pay you directly. And you need to talk to the lender if you're going to do that. Talk to your buyer's lender about what amount can go in there, because if the buyer needs other help with their closing costs, you just need to know. You should never put anything into 12A1B, and we're going to get there without talking to the lender. Okay, thanks.
Hey, that's a great point. Thank you, Z. Sorry. On VA, 100% financing. I don't know if many of y'all dealt with VAs, but 100% financing. It's a great program for them. You know, obviously the government is backing it. I guess what's important for everyone to know, there's what's called a VA funding fee. If they have any type of disability of 10% or more, there is no VA funding fee. If they don't have any disabilities, then depending upon how much they put down, if any, will determine what that VA funding fee is. Perfect credit's not important, as important. Debt to income ratios, I think on the prior slides, you can see up to 60%. We've seen those be approved before. And depending upon some of the VAs, their eligibilities, they can buy up to 2 properties. So there's really good flexibility. Obviously, just as a reminder, seller can pay up to 4% of the closing cost, and that includes prepaids. So
And VA and FHA loans are both assumable, correct?
they are. Now, what the key to that is, now you stay on that slide right here. So, but just to let everybody know, if they allow somebody to assume their VA loan, their eligibility is tied up until that loan is either paid off or the house is sold and the loan's paid off. So just FYI. USDA is for basically rural areas outside the Metroplex. We don't see much of this in the DFW area when you go north. But what everybody has to understand is no down payment required. Property must be in an approved area for USDA. Credit, you know, doesn't have to be perfect. But the key is the fourth bullet is that they can't make too much money. So if they make over a certain amount of money, they're not eligible. Okay, well, that's fine, Michael. My borrower doesn't make, well, what about the co-borrower if applicable? What about the children that live in the house? We have to take all of that in consideration. So a lot of people don't understand that. So just FYI, 97% of the land in the U.S. is eligible for USDA. Not much there. Jumbo loans, here's an update. Any loan up to 766,550 is conforming. Anything over the 551 is jumbo. So that has been confirmed. So it's been jumping up every year. Obviously, y'all know this as well as anybody. Homes are appreciating, and so Fannie and Freddie have been on top of increasing that. What you need to know in working with clients getting a jumbo loan, non-conforming loan. There's different risk guidelines for underwriting. So y'all done enough transactions to know this, but typically anybody above the conforming loan amount, we need really good credit scores, lower debt to income ratios. I've seen 46 get approved before, but with algorithms like Buck talked about, 43 is typically a safe harbor. Need more in reserves. Far as participation in the market right now, there are not a lot of people going in and bidding on jumbo loans. So, at one time, jumbo rates were better than the conforming rates. And then all of a sudden, everybody started getting out of the market and wanting to buy those packages of jumbo loans. So it's really, really a tough market right now with mortgage-backed securities. But I guess with the tightening of credit and everything, participants, we had maybe 30 participating. Now we're down to 8. So if y'all are wondering why is there such a disruption, that's really the case. Next slide.
So Michael, I have a question for
Yeah.
you, because we've been talking about the all-in-one, because it
Yeah.
seems like someone who's going to like finance $1 million is probably in a financial situation where they might be a candidate for that.
Yep.
Like what's the difference? Or if someone called and said, okay, I'm buying a $2 million house and I have $1 million to put down, I should want to finance $1 million. Like, would you look at them for jumbo and for all-in-one? Like, how does that work?
Well, that's a great question. And depending upon their cash flow and their situation, what I typically do is I show them the traditional, then I show them the all-in-one. Because in our portal with our software, I can compare the conforming fixed rate or the 7/1, whatever you want, what product, to the all-in-one. And it really shows the difference of the two, because it's all about paying less in interest. It's all about having the fluidity to obtain your equity. When we go into a traditional fixed or 7/1 ARM, you don't have that availability to get that equity to where the all-in-one you can. So I particularly compare the two just to educate them on the differences. But I will tell you, they're pretty firm on debt to income and on FICO scores. So, yeah.
All right. To go back to USDA, Linda is asking if rates are higher or lower or about the same for USDA.
Typically, they're a little bit higher because it is 100% and it is low income, but they do have the opportunity to buy down the rate if applicable.
Okay.
Great question. All right. I'm about done here. So this is on condos. A lot of people have a lot of questions. Can I do one? Can I not do one? I think the key word for everyone to know is it warrantable? What is it not? Or is it not warrantable? So we'll just go through this. This is really a good cheat sheet to talk about. As far as must meet an extensive list set by Fannie and Freddie in FHA, example, no timeshares or operate as a condo hotel. I mean, that's a stopper for Fannie, Freddie, and FHA. So we have a group here that represents a very high-end condo tower. Next to it is a hotel, and they're not eligible because it has that attachment to it. So just FYI. How do I determine whether it's a condo is warrantable? At least 10% of the annual budget must go to the reserves. So the HOA group should be able to provide that. They have to provide that so that we can determine whether it is warrantable or non-warrantable. At least half of the units must be owner occupied. So if 55% of the owners in that building is rentals, it's not warrantable. So they have their ratios, who is owner occupied, who's not, with the home association group.
And so on the
go ahead.
listing side, guys, as a best practice, if you get a condo listing, you need to know whether it's warrantable or not warrantable. And if it's not warrantable, you need to know if there are any lenders who are willing to finance on it. And you kind of have to go through the past MLS history and call other listing agents and see, which sounds kind of weird, but if you get a condo listing, you know, our best practice at Briggs Freeman's is to get the HOA documents up front so that you can deliver them as part of the offer, and the buyer kind of acknowledges receipt, which eliminates their ability to terminate. But you also need that to figure out warrantability. So, you know, if you go through Momentous, they'll order the HOA docs and kind of front the cost and do it for you upfront so that you can have all of this information to be like a prepared listing agent. Does that make sense? If you guys have questions about that, let me know. Sorry to interrupt, Michael. I just wanted to throw that in there.
No, I'm glad you did. And you know, to give you an example, in the all-in-one, they don't accept non-warrantable. Okay, 1. 2, we as a lender, I mean, we're the fifth largest non-bank lender in the country. We do have products that will finance on non-warrantable. But I think we all have to understand is the rates higher, you know, things like that. So, but we do have some lenders that will lend to non-warrantable units. What is non-warrantable? Just real quick, team, I really appreciate your patience. One is require membership, such as a golf club or a country club. That's non-warrantable. Operate as a hotel or a motel, also known as a condo. I call it condo hotel. 3, be a part of a continuing care facility. That's non-warrantable. The party to a lawsuit, I think we all know what that means. Allow single people or businesses to own more than 2 units in a development. For a development with 20 units or less, or 20% of the units in the project for a development with 21 units or more. So it's just important. If you have 40 units and you have an investor that owns 10 of them, it's going to tell you more than likely it's non-warrantable. Feature non-residential or commercial space exceeding 35% of the total space in the project. I talked to a client the other day. It became non-warrantable because a certain percentage of the owners were using it as commercial, their office, and not living in it. And then, of course, they had one particular customer that owned excess of the amount allowable to make it warrantable as far as rentals. Have more than 15% of the units in the project 60 days or more delinquent on their HOA. First thing we do as a team, our processors, is get that information from the HOA. So we're not wasting your client's time, wasting your time on trying to win the bid or find out it's just not financeable. So that's it from me. Hope y'all have a great weekend. Maria, you knocked it out of the park last night. That was a great event. Thank you very much, and congratulations to y'all that won awards.
Thank you, Michael. Well, while we have him, do you guys have any questions specifically about loans? Because like I said, we're going to go through some of the like contract addendums that pertain to financing, but do you have any loan questions, anything that's happening currently with a buyer? You can ask him now. You guys also can call any of the loan officers at any time and they'll answer your question. One thing I did want to explain to you guys is that, you know, we have 3 loan officers right now, and you know, you're not like restricted to working with the one that's tied to your office. I had an agent ask me the other day, like, you know, I love the loan officer in our office, but this particular buyer, I think would be a great fit for that loan officer. Like the reason that we have multiple is so that there's a deep bench, just like when you guys, if you're going to make a referral of a client to like an agent in another market, you want to make sure you find like the right agent for that client, right? Not just randomly pick someone. So you can, all of these guys are super, super knowledgeable. You can reach out to any of them with questions anytime. So I just wanted to make that clear. Any questions about loans?
No.
Okay, my last pitch, just real quick, and I'll let you
Do it.
take over, is
Yeah.
1, our goal is to protect your commission. 2 is to increase the commission. So we have a process that we do that. So if you ever want to visit about it, please give one of us a shout. Thank you.
Yeah. Awesome. Thanks, Michael. Okay, guys,
Okay.
so we're gonna go, we have 9 more minutes. We're gonna go through the forms that pertain to financing, and we'll just get through as many of them as we can. I was gonna talk about third-party financing, the right to terminate due to lender's appraisal, the section of the paragraph that discusses repairs, closing costs, and then the non-realty items addendum. So I'm just gonna breeze through these, and you guys are gonna look at the side of my face because I'm looking at this screen of mine. But, so this is the third-party financing. Obviously, you attach it if your buyer wants a financing contingency. And you check on the first paragraph relates to the type of loan that your borrower says that they will apply for. And I would say if they don't know if they're gonna go conventional or FHA, like I would check both and you fill them out. How much are they gonna borrow? What type of loan are they pursuing, 30 years, 15, and then what are the interest rates here and what are the points? Again, if you're writing an offer for a buyer, you should already be like connecting with the lender should be part of your team. Like I always say, the agent is the quarterback, but we have all these different like people on our team, and the lender is a very, very important one. So you guys should be talking and communicating regularly as you're writing offers. So that's all pretty straightforward. Your lender should always be able to respond and just tell you what to put in these blanks. But I want to point out this paragraph G, because this was new. This is the 2022 version of the form, and this was the new paragraph that was added. And this basically contemplates a situation where if someone's getting a loan from like their private wealth manager or a hard money loan, this is what you fill out. Because we've all been in the situation as the listing agent where the buyer presents the cash offer, and then in 2 weeks we get a call from the appraiser, and the listing agent and the seller are both really mad because they're like, this feels like a bait and switch. So this is a way for you to present your offer like that's basically a cash offer, but is getting financed, right? And by basically a cash offer, I mean, there's no contingencies. And what you would do here is, you would check here, you would put like the name of the hard money lender, then you'd say, how much are they borrowing? What are the terms? And then here, this last sentence is what's really important, which is what makes it seem like you're presenting as if it were a cash offer. Buyer does or does not waive all rights to terminate under paragraph 2B. So if you say buyer does waive all their rights to terminate, you're basically saying there's no contingency on the property approving here. So yes, a lender is involved. There's no contingency. So even if an appraiser shows up, it's not contingent on that, right? And then, if you would also check this box in that circumstances, it's not subject to buyer obtaining approval. We just waived these contingencies. And so you're basically presenting an offer as if it were cash, but disclosing that there is some type of hard money or totally non-contingent loan involved. Does that make sense? I can't see you guys, so if it doesn't make sense, put it in the chat or speak up. I just wanted to point out that paragraph. It's new and it's pretty valuable so that you guys don't have to kind of misrepresent a cash offer if they're actually getting some type of financing. So the second paragraph of this form is paragraph 2, and this is where the contingencies are created, and it pertains to financing being approved. And you can see here in our bold and conspicuous language that time is of the essence, so you have to strictly comply with deadlines here. So there's 2 contingencies built into this form, and they're separate, totally separate. The timelines are separate. What they're looking at is separate. 2A relates to the individual buyer qualifying, meaning they have to give the loan officer like all their documents, all their everything, all their tax returns, and the underwriter has to review it. And that's the one where you set the amount of time. So if you have a buyer who has been talking to the lender and the lender has most of their stuff, you can call the lender and say, how long do you really need? And the lender will say, okay, well, if they get me their tax return, I need 7 days or I need 14 days or whatever. So what goes in that blank is usually, between 7 and 21 days. To me, 21 days is really long, and it means either the lender is slow or the buyer has not really gotten that far into the loan process and hasn't started gathering all their documents. So as the listing agent, you want to see like a low number in that, or you want to just see like this buyer already has given the lender everything and the buyer themselves is approved. So there's no contingency on that. So if you check this second box here, it's saying it's not subject to the buyer obtaining buyer approval, probably because the buyer has already been approved. Does that make sense? Speak up if not. And that's where you have a number of days that you guys negotiate. The second part is what relates to the property being approved. And you can see there's no blank for us to fill in because the timeline here is no later than 3 days before closing. So you don't have to get the appraisal done during the option. You don't have to get the appraisal done during this number of days. As long as you get this information back no later than 3 days before closing, you have the right to terminate due to the property not appraising or there being some issue with the HOA documents or the insurability, something like that. But the lender is going to have to explain why did the property not qualify? Was it the appraisal? Was it some issue in the HOA documents, et cetera, et cetera. So those are two separate and distinct ones. Hopefully that makes sense. I still have very experienced agents that call me and ask questions about that. And then here, well, for FHA and VA, this is called I think it's called the amendatory clause, but it has to appraise for the sales price with those loans. So you put the sales price in this blank. And then last here, I just want to point this out. Buyer authorizes their lender to furnish to seller or buyer or their representatives information relating to the status of the approval for the financing. So you as a listing agent have the right here to communicate with the lender and see how it's going. That's given in this form. So just wanted to point that out. Any questions on that form? I'm
No.
talking fast, but okay. Next form is this one. Okay, I feel like I talk about this form all the time, but we're just going to go through it quickly. This one is what the seller wants to see. It's a full waiver. It says it doesn't matter what it appraises for. This buyer is checking is going to show up to closing with the money that they need. Before you check this box, you need to check with their lender to make sure that the buyer can in fact do that. If it's $1 million property and they say it's a full waiver and then it only appraises for 750 and the buyer has to bring up 250, the lender may say they can't do that. They don't have the funds or it's going to mess up their ratios or whatever. So before you fill this out, you need to talk to the lender. Same thing here. This is a partial waiver. This says the buyer waives their right to terminate as long as it appraises for this much. So in my example, on $1 million sale, they say, we're going to waive the right to terminate due to appraisal as long as it appraises for 900 or 950 or whatever. So that's at least puts a floor on the amount of cash the buyer would need to bring to closing. This one right here, this is totally different situation. This is used in the situation where your buyer is putting so much cash down that the lender is not going to have a problem with the appraisal. So say on my $1 million property example, the buyer is just wants to finance $250,000, just a little bit, right? They're going to put cash down, $750,000 in cash and just finance a little bit. So they have like a small loan on the property. So if the property only appraised for like 800, but the lender's only financing 250,000, they're not going to care that it didn't appraise, right? The lender's not going to care. They're not going to tell the buyer, like, we're not financing this because the lender is well secured. So they're going to, in that instance, your buyer may want to say, like, look, if I'm putting $750,000 of cash down, I want this property to at least appraise for 800,000 or whatever number that they feel comfortable with. But you have to have a certain number of time to get the appraisal done. Does that make sense?
Yes.
Okay, perfect. Okay, so real quick, I'm just going to point out here that with respect to lender required repairs, neither party has to do lender required repairs. Those usually come up in FH or VA. And so if they don't, then the buyer has the right to terminate. If the amount of repairs exceeds 5% of the sales price, even if the seller says they'll do it, the buyer doesn't have to proceed. And then here also, I like to point out that the contract provides that repairs and treatments must be performed by persons who are licensed to provide repairs, or if no license is required, are commercially engaged in the trade of providing such repairs or treatments. What that means is that your seller cannot roll up their sleeves and go fix the sprinkler system. They have to hire someone to do it. And now they have to provide copies of the documentation to the buyer to prove that it was done. So I just want you guys to be on notice about that. I see all the time agents write licensed plumber will do this. Like, you don't have to write that. It's in the contract. Okay, here, this is 12A1B. This is the amount of closing costs that the seller is going to contribute to the buyer. My only thing I'm going to say here is do not put a number in this blank without talking to the buyer's lender, because if you're going back and forth about repairs and you're like, you know what, the buyer's just going to ask the seller for $20,000 towards closing costs, and then they'll take care of all the repairs after closing. As you saw when Michael was talking earlier, there's only a certain amount of seller paid closing costs that are allowed with certain loan types. So you need to talk to the lender and see what can go in that blank, because if you negotiate for $20,000 and there's only $15,000 worth of available like closing cost credits under the loan, you do not get the benefit of that $5,000. Okay? All right, you guys are getting the quick and dirty version of this, which is fine. The last piece here is with the non-realty items in general, generally speaking, lenders want to finance with the collateral being the home itself and not like all this personal property. So if you use this, the number that you put needs to be like a very small amount, right? It needs to be nominal. Like I would say $10 or less, and then you list the items. If you have $20,000, the lender's not gonna like that because then they've appraised the property, but it just gets messy. So we can do personal property items separately if it's a large value, and just reach out to me or Angela and we can help you guys with that. Okay? All right. Unfortunately, we don't have time for questions, but if you have questions, these are the guys, reach out to them. Thank you guys for coming. If there's a question in the chat, call me and we can get it sorted out. For CE credit, I have Kim, Hattie, Michelle, Maria, Poget. If anyone else wants CE credit, please put it into the chat now. Your name and your license number. So sorry guys, to be quick, I got a call at 10. So thanks so much for
Thank
coming.
you.
Bye.
Thank you.